You are watching a live chart, tracking the jagged movements of an asset, when a textbook Morningstar pattern materializes on the screen. Seeing the textbook reversal signal, you execute a buy order. But instead of the market climbing, it immediately drops. Your position is stopped out for a severe loss. The shape of those 3 candles was technically perfect. The failure happened because the environment was wrong. The market was moving sideways in a choppy range with no established trend to actually reverse. Memorizing candlestick shapes in isolation is a trap. It generates meaningless noise and drains your trading account because shapes without context have no predictive power. To stop guessing and start pulling consistent profits, you must evolve from a pattern spotter into a technical strategist who reads the underlying market narrative. Morning and evening star patterns map a specific 3-part power struggle between buyers and sellers. On this chart, a long bearish candle represents the trend's final push by sellers. Next, a small gapped-down doji prints, signifying neither side can gain control. Finally, a bullish candle surges upward, closing deep within the red candle's body. This is the decisive counterattack. The deeper that third candle closes into the first, the stronger the evidence that a new group of buyers has taken control of the market. But finding this 3-candle structure is only useful if you first identify a preceding sustained trend. A morning star is only a valid signal at the bottom of a significant downtrend, and an evening star only at the peak of an uptrend. To filter out fakeouts, technical strategists use confluence, the practice of layering multiple independent signals at the same price level to validate the reversal. First, market structure. The morning star sits perfectly against a historical support zone, acting as a floor. Second, a volume spike on the third candle proves institutional backing. Finally, an RSI graph shows a rising line contrasting the falling price, proving downward momentum is exhausted. When a support zone, institutional volume, and momentum divergence align, the pattern becomes a high-probability trade setup backed by multiple layers of evidence. Identifying a verified confluence setup is only the first step. You still need a mechanical plan to enter the market. You can use an aggressive entry a moment that third candle closes, or a conservative entry, waiting for a slight price pullback to retest the new support line. Your stop loss is non-negotiable. Place it just past the extreme low of the middle star candle at this red line. Next, pan left to the previous structural peak for your target. Finally, ensure your target distance is at least twice your stop loss. Before executing, calculate your position size. You should only ever risk a fixed 1 to 2% of your total capital on a single setup, regardless of how strong the signals appear. You can practice identifying these confluence setups and executing your entries without risk by opening an FXNX demo account on the NX1 platform. Long-term profitability isn't about predicting a single market turn. It's about applying disciplined risk management to a validated edge over hundreds of trades.